If you locked into a fixed rate mortgage back in 2020 or 2021, you made off like a bandit. Rates were rock bottom, and anyone who secured one of those ultra low mortgages is probably still bragging to family about it at family dinners. But here's the thing. Just because fixed rates worked out incredibly well in a small window of time, that doesn't mean fixed rate mortgages are always the smartest move. And this year, there are some real reasons why choosing a fixed mortgage could be a massive mistake. Now, before I get into it, let's set the stage. We're in a housing and interest rate environment that's unlike anything that most Canadians have experienced. Over the past few years, we've seen interest rates swing harder than the Blue Jay slugger. In 2022, the Bank of Canada raised rates at the fastest pace in history, something almost nobody saw coming. And now here we are, a couple years later with rates holding steady, but uncertainty still hanging in the air. Everyone's asking the same question. Should I lock into a fixed or take my chances with a variable? And listen, this isn't about hyping one choice over the other. This is about understanding the risk and the hidden traps that come with fixed rate mortgages. Because too often people focus on one number, which is the rate, and they forget everything else that comes with it. And that's where homeowners get burned. So here's what I want to walk you through today. I'm going to break down the major reasons why fixed rate mortgages might not be the best choice this year. We'll talk about where interest rates are headed and the difference in how fixed and variable performs historically. And this is a big one, the massive penalties that come with breaking a fixed mortgage before the end of your term. And spoiler alert, most Canadians don't even make it to the end of their 5-year term. On average, they break their mortgage at about the 3.7-year mark. That means penalties are not some rare maybe it'll happen event. They're a reality for the majority of people. But I know what you're probably thinking. But Justin, fixed gives me certainty, and I want to know my payments won't change. And you're absolutely right. Certainty has value. But here's the problem. Certainty comes at a cost. And often that cost is way higher than people realize. And when life throws you a curveball, whether it's a job change, a growing family, or an unexpected move, that certainty can actually become a financial trap. So in this video, I'm going to break down the 5 key reasons why fixed rate mortgages might not be the best move this year. And by the end, you'll not only understand the numbers, you'll understand the risks, the flexibility that you could be giving up, and the penalties that could eat away at your hard-earned money. So let's dive into reason number 1, what happens if interest rates start coming down? All right, so now that we've set the stage, let's get into the meat of this. There are 5 big reasons why fixed rate mortgages might not be the right move this year. And I want you to pay attention here because these aren't just theoretical risks. These are real world traps that I've seen Canadians fall into again and again. So reason number 1 is betting against falling rates. So right now, fixed rates are sitting around 5%. Variable rates are just slightly higher. So on paper, fixed looks like the smarter play. It's cheaper today. But here's where people get tripped up. If you believe rates are going to fall, locking into a fix means you're betting against yourself. And here's why. For variable rates to actually beat out fixed, rates don't just need to fall a bit. They need to fall a lot, more than a full percentage point before you really start saving money. And historically, that kind of sharp drop doesn't happen overnight. Yes, rates went up to 5% in less than 2 years back in 2022. But the reverse, rates falling that quickly, is much less likely. So if you're locking into a fix because you think, well, this is the safer, this guarantees me savings, you could actually be boxing yourself out of future opportunities. Fix can give you certainty, but it takes away flexibility. And in a market where rates could shift down over the next 2 or 3 years, that certainty could cost you thousands. Reason number 2, statistically variable wins. When we zoom out and study the history, variable rates have outperformed fixed more often than not. I'm saying that because that's what the numbers show. Over decades of Canadian mortgage data, variable rates have saved borrowers more money in the majority of cases. Not every single year, not in every single market, but when the 2 rates are close, variable usually comes out ahead. Here's the thing, variable rates reward people who can stomach a bit of risk. If payment fluctuation stresses you out, fixed may still feel better for you. But if you're comfortable with some short-term uncertainty, variable tends to win in the long-term game. So ask yourself, am I choosing fixed because it's truly the better financial option or because it just feels safe? Because feelings don't pay your mortgage, numbers do. Number 3, the penalty trap. This is a big one. The number one reason people regret locking into a fixed rate mortgage, the penalty. If you ever need to break your mortgage early, and most Canadians do, you could be hit with what's called an interest rate differential penalty. At the big banks, those penalties can be massive. I'm talking tens of thousands of dollars. And the worst part, most homeowners don't realize how big these penalties are until they're sitting across from their banker and getting the bad news. Now, let me give you a stat that should really sink in. The average Canadian doesn't make it through their 5-year mortgage term. Most break their mortgage around 3.7 years in. That means that the majority of people don't actually get to the end of their contract. They pay it out early, whether it's because they're moving, refinancing, consolidating debt, or making a lifestyle change. And that's when the penalty comes knocking. Now, yes, there are exceptions. Broker-only lenders, called monolines, usually have much softer penalties, often 3 to 5 times smaller than the big banks. That can make fixed a little bit less scary. You're still giving up flexibility. You're still signing a contract, even though the odds say otherwise. Reason number 4, life happens, you're moving. Let's be real. Life always doesn't follow the neat 5-year timelines that fixed rate mortgages expect. Think about it. Will you definitely be in the same home, in the same city, in the same financial situation in the next 5 years? Maybe, but maybe not. Job transfers, growing family, downsizing, divorce, it happens all the time. And here's the trap. If you're locking into a fixed and you suddenly need to move, that penalty could wipe out your equity. I've seen people forced to sell their home only to realize the penalty eats into their down payment for the next one. And that's absolutely heartbreaking because it puts you in a position where you feel stuck. You want to move forward, but your mortgage contract is literally holding you back. So when you're thinking about fix, don't just ask, what's the rate today? Ask, how likely will I need flexibility in the next 5 years? Because if the answer is pretty likely, then fix could actually cost you more in the long run. Reason number 5, refinancing flexibility. One of the biggest tools homeowners have is the ability to refinance when the market shifts. Maybe rates go down and you want to take advantage of a lower payment. Maybe you want to pull out equity to consolidate high interest debt. Maybe you want to renovate or invest. If you're in a fixed mortgage and rates have dropped, that interest rate differential penalty can slam the door on those opportunities. Instead of refinancing and saving, you're stuck paying thousands just to get out of that contract. I can't tell you how many times I've seen homeowners leave money on the table because of this. They were in a fixed mortgage, rates fall, and suddenly refinancing wasn't an option without paying a penalty so large to erase the savings. It's super frustrating and it's completely avoidable if you plan ahead. So let's recap quickly. Fixed can backfire if rates fall. Variable has historically outperformed fixed. Fixed mortgages come with massive penalty risk, especially at the big banks. Life happens. Most Canadians break their mortgage before the end of the term. And if you want to refinance, fixed can trap you and keep you from accessing savings. And if you want to refinance, fixed can trap you and keep you from accessing savings. This is why I say don't just chase the numbers. Don't just grab the lowest rate you see on a billboard. Look at the full picture because the hidden cost of fixed could outweigh the comfort of knowing your payment won't change. Move to the final part of this video, where we'll break it all down to what the smartest choice for your situation and what steps that you can take before committing to a mortgage this year. So here's the bottom line. Choosing between fixed and variable is really about choosing between certainty and flexibility. If you are the kind of person who absolutely cannot stomach the idea of your payment ever changing and you're confident that you'll stay in your home for the next 5 years, then yes, fixed might give you peace of mind. And for some people, that peace of mind is worth it. But for most Canadians, life is unpredictable. Job change, family growth, marriage ends, opportunity comes up, And when those things happen, the flexibility of variable rate mortgages or even shorter term fixes like a 2 or a 3-year option can save you from massive penalties or give you room to adapt. Smart borrowers don't just ask, what is the lowest rate today? They ask, what's likely to happen in my life over the next 3 to 5 years? How much risk am I actually comfortable with? And if I had to, and this is where a mortgage broker comes in, because a good broker isn't just shopping for the lowest number. They're looking at the big picture. They're factoring in your plan, your risk tolerance, and your goals. That's how you avoid the traps. And here's why this is so important right now. We're in one of the most uncertain markets in decades. Rates could drift down, they could hold, or they could surprise us again. Nobody, even the economists of the big banks, can say this for sure. What we do know is this: locking into a fix today means betting against flexibility. And in a world where change is the only constant, flexibility often is more valuable than certainty. So here's my advice. Before you sign the dotted line, run the numbers both ways. Look at the penalty calculations. Look at the likelihood you're going to move or refinance. Don't just take the deal your bank is pushing because it's the safe one. Talk to a mortgage professional who can walk you through your options. That way, you're not just picking a rate, you're choosing a strategy. And trust me, the right strategy will save you a lot more money than 0.5% difference in interest ever will. So should you avoid fixed rates this year? For most people, yes. Not because fixed is evil, but because fixed can trap you in ways that you don't expect. Flexibility in this market could be worth far more than the certainty. So thanks for watching. If you found this breakdown helpful, hit the subscribe button. It really helps more Canadians see the content like this. Don't forget to subscribe for weekly mortgage insight. And if you're ready to figure out the right strategy for your situation, my calendar link is below in the description. Book time and let's make sure that you're set up with a mortgage that truly fits your life this year.